Welcome to our latest equity research briefing. Today, we are initiating coverage on the electronic design automation and semiconductor intellectual property sectors, which we view as the hidden backbone of the generative AI compute cycle. While retail flows have chased merchant silicon providers like NVIDIA and AMD, institutional capital is quietly accumulating the pick-and-shovel providers. Companies operating in the EDA duopoly possess some of the widest economic moats in the technology sector, characterized by extreme switching costs and nearly impenetrable barriers to entry. Our thesis is simple. Regardless of which semiconductor designer wins the AI hardware race, they must pay a toll to the EDA and IP gatekeepers. We are modeling a 15% compound annual growth rate for the sector over the next 5 years, supporting our overweight rating. To understand the valuation premiums awarded to this sector, we must first analyze its market dynamics. The EDA software market operates as a highly consolidated oligopoly, essentially dominated by Synopsys and Cadence, which collectively command over 70% of global market share. This duopolistic structure provides unparalleled pricing power. Semiconductor design is a multi-million-dollar, multi-year process where a single silicon bug can cost hundreds of millions in delayed time to market. Therefore, chip designers exhibit virtually zero price sensitivity when selecting EDA tools. Consequently, these companies generate highly visible, recurring revenue streams with gross margins consistently exceeding 80%. We view these structural advantages as a permanent fixture, insulating the group from the typical cyclicality associated with downstream semiconductor manufacturing and capital equipment. A primary catalyst driving forward earnings revisions is the proliferation of custom silicon among Tier 1 hyperscalers. Amazon Web Services, Google, and Microsoft are aggressively ramping internal ASIC development to reduce reliance on merchant GPU suppliers and optimize total cost of ownership for AI workloads. Each custom AI accelerator, such as Google's TPU or AWS's Trainium, requires massive deployments of EDA software and licensed IP blocks. This shift effectively democratizes semiconductor design, expanding the total addressable market for EDA vendors beyond traditional fabless chip makers. Our quantitative models indicate that hyperscaler ASIC projects will account for nearly 25% of incremental EDA revenue growth over the next 36 months, providing a massive non-cyclical tailwind to the sector's top line. Turning to the financial profile and margin trajectory, the EDA and IP sector operates on a highly attractive financial model that blends software-as-a-service recurring revenues with significant operating leverage. Over the trailing 12 months, top-tier EDA firms have reported unearned revenue growth exceeding 20% year-over-year, providing excellent top-line visibility. More importantly, these companies consistently satisfy the Rule of 40 metric, balancing top-line growth with robust free cash flow generation. We are projecting non-GAAP operating margins to expand by 150 to 200 basis points annually over our forecast period. This margin expansion is driven by economies of scale and the introduction of higher-margin AI-assisted design modules, which command premium licensing tiers. Addressing valuation, the bears often point to elevated multiples as a primary risk. Currently, the peer group trades at approximately 38 times next 12 months enterprise value to EBITDA and a low 40s forward PE. While this represents a premium compared to broader semiconductor capital equipment names trading closer to 20 times, we argue this premium is entirely justified. When adjusting for growth, the PEG ratios remain historically normalized. We apply a discounted cash flow valuation methodology, utilizing a 9% weighted average cost of capital and a 3.5% terminal growth rate. This DCF output implies a 15 to 20% upside from current trading levels. The durability of their free cash flow streams warrants a software-like multiple rather than a hardware-like multiple. Moving down the stack, semiconductor intellectual property, or IP, represents the second pillar of this ecosystem. Rather than writing code from scratch, chip designers license pre-verified architectural building blocks. ARM Holdings is the most prominent example, operating on a dual revenue model of upfront licensing fees followed by per-chip royalties. As AI processing moves to the edge, including AI-enabled smartphones and automotive inference, the complexity of these architectures increases. Higher complexity translates directly to higher royalty rates per device. Furthermore, the transition to ARM v9 architecture is demonstrating significant royalty rate expansion, increasing from roughly 1.7% to over 2.5% per chip. This creates a high-margin annuity stream that compounds as global silicon volumes expand. Capital expenditure and R&D intensity are critical metrics for maintaining these economic moats. To sustain their duopoly, EDA and IP leaders reinvest roughly 30 to 35% of their revenue directly back into research and development. This staggering absolute dollar figure creates a virtually insurmountable barrier to entry for prospective startups. We closely monitor the R&D to revenue ratio. An inflection point where revenue growth outpaces R&D spending indicates immense operating leverage. Our analysis shows that we are currently entering such a phase. The underlying code bases are largely established, allowing these firms to harvest cash flows while incrementally bolting on AI-driven features like reinforcement learning for chip floor planning, which further reduces design cycles for their clients. It is imperative to address the bear case and downside risks to our overweight thesis. First, geopolitical friction remains an ever-present overhang. Export controls restricting the sale of advanced EDA software to Chinese entities represent a tangible near-term headwind, as China historically accounted for 15 to 20% of aggregate sector revenue. Second, aggressive customer consolidation poses a threat to pricing power. If the semiconductor industry experiences a wave of mega mergers, fewer discrete design projects could compress the total available licensing pool. Lastly, while the recurring revenue model dampens volatility, a severe global macroeconomic recession that slashes hyperscaler capex and delays next-generation node transitions would inevitably impact booking run rates and compress valuation multiples. Conversely, our bull case scenario is predicated on the rapid monetization of AI-assisted design tools and the shift to advanced packaging. As Moore's law slows, the industry is pivoting towards chiplet architectures and 3D packaging. Designing a multi-die chiplet system exponentially increases the complexity of thermal management, signal integrity, and verification. This complexity is a massive revenue driver for EDA vendors. Furthermore, tools like Synopsys's DSO.ai use reinforcement learning to autonomously route billions of transistors, accelerating design cycles by weeks. As clients adopt these premium AI modules, average revenue per user could expand by 30% or more. In this upside scenario, we model EV to EBITDA multiples sustaining above 45 times. In conclusion, we view the EDA and semiconductor IP space as an essential lower-risk derivative play on the ongoing artificial intelligence supercycle. The sector offers institutional investors a rare combination of utility-like revenue visibility, software-like gross margins, and semiconductor-like secular growth. Despite premium valuations, the compound annual growth of free cash flow makes this sector a core holding for growth-oriented portfolios. Our actionable setup recommends using any macroeconomic-driven pullback to accumulate shares of the primary duopoly players. We maintain a sector overweight rating with customized price targets reflecting a blended 40 times forward earnings multiple, supported by robust hyperscaler demand and an expanding footprint in the custom silicon market.